Hello everyone. Today's topic is going to be how to perform an impairment analysis. The topic could be quite complex, so we are going to start from the basics, go through a trigger analysis, all the way through a Step 1 and Step 2 impairment analysis. But before we do, please subscribe so you don't miss any future content, and comment with any questions or topics you want to see covered. Okay, let's start with what an impairment is and why we might need to do this analysis. Under ASC 360, when events occur or circumstances indicate that an asset group's carrying value may not be recoverable, then a recoverability test should be performed. If that asset group is not recoverable, it should be written down to its fair value. Simply put, if you have an asset group on your books that cannot generate cash flows exceeding its value, then it should be written down to its fair value. Now, we mentioned the term asset group. There's a similar term under IFRS called the cash generating unit, or the CGU. The concepts are similar, but under ASC 360-10-3523, an asset group is the grouping of assets and liabilities at the lowest level for which identifiable cash flows are largely independent of cash flows of other assets and liabilities. So, what does that mean exactly? A good way to think of this is, what is the lowest level that management reviews the performance, tracks assets, or looks at financials of the company? We wouldn't look at an office building and assume it should have cash inflows, as typically they service the whole company. However, perhaps a division of a company, such as for an oil and gas company, might be the region that it works in. Or for a manufacturing company, it may be a specific product line. These are identified as the asset group. The CGU under IFRS is mostly similar in nature. Under US GAAP, there are 3 steps to determine an impairment. The first step is called a triggering event analysis. I consider this step 0. If no triggers for impairment are identified, you would stop here and nothing further is needed. If there are triggers, you must move to step 1, which is an undiscounted cash flow analysis. The analysis looks at the cash flows projected by the company for the asset group with no discounting applied. If step 1 reveals that the undiscounted cash flows are greater than the asset group, again, there is no impairment and you stop here. If the undiscounted cash flows are less than the carrying value, you move to step 2. To impair the asset to its fair value. Typically in this step, you would discount the cash flows from step 1, but you would look to ASC 820 and potentially there are other ways to value the asset, such as recent purchases of similar assets in the market between willing market participants. So, in summary, the first step is a trigger analysis. Is there indicators of an impairment? After that, step 1 is an undiscounted cash flow model. Are these cash flows more or less than the carrying value? And then step 2, write the asset to fair value. Now, under IFRS, there are 3 differences. First is that there is no undiscounted cash flow analysis. You simply move from the trigger analysis to the step 2 analysis. The second difference is that IFRS refers to a term called value in use, or VIU, which is your actual cash flows versus a best use by the market when determining fair value. In theory, fair value and VIU should be similar, but there can be differences. Lastly, under US GAAP, you can only write assets down in value, but under IFRS, you can write them back up to their carrying value minus normal depreciation. So if in 1 year you write the assets down and long-term conditions improve, you could potentially undo that impairment at a later date. Okay, let's first look at what the guidance indicates could be a triggering event. At ASC 360-10-35-21, there are 6 indicators of impairment. The first is a significant decrease in the market price of long-lived assets. Let's say you're a company that made photo rolls at the time of an explosion of digital cameras. The market would devalue these companies and it would be an indicator of the market price of your asset group diminishing. The second trigger is a significant adverse change in the extent or manner in which a long-lived asset is being used or its physical condition. A good example of this would be, let's say you had horses that pulled your plows in the field and you bought a tractor. Your horses are now no longer being used in the same way, and this could be a triggering event. The third trigger is a significant adverse change in legal factors or in business climate that could affect the value of long-lived assets, including an adverse action or assessment by a regulator. A good example of this would be a coal company and laws and regulations changing, making that company's product less desirable or even uneconomic by government rules. The fourth trigger is an accumulation of costs significantly in excess of the amount originally expected for the acquisition or construction of a long-lived asset. This is a simpler example. So let's say you were constructing a new hospital and the cost overruns were in such excess that it may make the hospital's future uneconomic. This could be a trigger, and you would move to a step 1 analysis. The fifth trigger is a current period operating or cash flow loss combined with a history of operating or cash flow losses, or a projection or forecast that demonstrates continuing losses associated with the use of long-lived assets. So if the price of oil drops and oil drilling companies can no longer drill oil economically at the current price, this could be a trigger for the asset group. The last trigger is a current expectation that more likely than not, a long-lived asset will be sold or otherwise disposed of significantly before the end of the previously estimated useful life. So let's say you're a newspaper company that has entered the digital age and won't be using your printing presses anymore. You may be selling those machines at a steep discount to the expected value as the equipment has reduced demand for it. So, in summary, there are 6 triggers laid out in ASC 360-10-3521 for an impairment. The first is decreases in market prices. Second is adverse changes in use or condition. Third is adverse changes in legal or regulatory environment. Fourth, excess costs over expectations. Fifth, operating losses or projections. 6, sales at a loss. So let's go through some examples. Our first example is a manufacturing company that's business is booming. They had a shutdown for a few days, but still ended up recovering lost production by the end of the month. Based on the 6 triggering events in ASC 360, this scenario would not result in an impairment trigger. Therefore, after this analysis, the company would conclude there is no impairment indicators. Now let's say that same manufacturing company had a significant fire and a large amount of costs will have to go into restoration efforts, and business will be down for months. This is a slam dunk for an impairment trigger, and you would move into step 1. One more example. Let's say you were a coal miner and new laws and regulations added burdens to your company going forward. This would be a trigger on the adverse laws and regulations, and you would move to step 1. So let's explore what happens after a trigger is identified. Let's follow a hospital who had a trigger due to a pandemic. There is uncertainty for their future. A lot of procedures are being put off till the pandemic is over. However, they have reworked the hospital to help fight the pandemic. After the trigger was identified, the company would project cash flows for the business. These cash flows would not be discounted. You would then compare the sum of those undiscounted cash flows to the carrying value of the asset group. If the undiscounted cash flows are larger than the carrying value, you stop there and there is no impairment. However, if the carrying value is higher than the undiscounted cash flows, you move to step 2. Now for step 2, you should follow ASC 820 in finding a fair value. But for ease, we have already put together cash flows in step 1, and we will assume that that is the best use and therefore the fair value cash flows. When we apply discounting to those cash flows, we find the fair value of that asset that it would be written down to, and the difference is your impairment expense. So let's wrap up there. Comment with any additional questions you may have, and we can expand and help. Please subscribe so you don't miss any new content. Alright folks, thanks so much for watching. Please like, share, comment, and subscribe. And if you can, donate at Patreon. Anything you can give helps to keep the lights on and ensures we can continue to create content. And of course, helps feed FIFO. If you want to contact us about anything you saw in this video, accounting advice, or ideas for future videos, contact us at patreon.com/accountingacademy.
This video is designed to be illustrative and does not represent an official position. We make no representations, warranties, or guarantees and assume no responsibility for the application of this material. Please seek advice from a competent professional if expert assistance is required.